Hi, everyone. Welcome to the TimingResearch.com Crowd Forecast News, episode number 198 for October 1st, 2018. We are broadcasting live on YouTube at 1 p.m. Eastern Time. But if you listen to podcasts, I'm also posting the audio-only version of all episodes onto iTunes, Spotify, Stitcher, Podbean, and wherever else people listen to podcasts. So just search for Timing Research and subscribe. But if you're watching live or watching the video recording, you should be seeing the PDF version of the report for this week on your screen right now while I'm talking. And you can also go to TimingResearch.com/reports to download the PDF version or read the browser version. I have Rob Hanna back to moderate today, so I'm going to go ahead and turn it over to him.
All right, thanks, David. Great to be back. Looks like we got a mix today of people I've had the pleasure of speaking with before here, and some people that I haven't been introduced to before. So why don't I start off? I'll let everybody introduce themselves, and we can just kind of go through, and I'll let you say hello. Tell us a little bit about your background, I guess, and about your site. I just wrote everyone's name down pretty much as they went out in the email to me. So let me start with Tim. Is it Racette?
Yep, that's right.
Okay. E-Mini-Mind. And yep. Nice to meet you, Tim. You're going to tell us a little about yourself and your site and what you guys do.
Yeah, likewise, Rob, and thanks for inviting me on, Daniel. So my name's Tim Racette, and I'm originally from the Chicago area. That's kind of where I got my start, down at the Board of Trade. And now I live in Arizona, and I day trade the futures markets. I swing trade the stock market, and trade a little bit of options as well. I blog over at eminimind.com. That's my website, and just kind of share my methods and chat with other traders. I spend a lot of my time in the ES, in the NASDAQ, in the Euro futures. And like I said, mostly day trading those futures markets, and then swing trading various stocks, higher volume stocks on an overnight basis.
Great. Tim, do you consider yourself mostly a technical trader if you're trading, or how do you?
Yeah, absolutely.
Okay.
I'm just looking at the charts. I pay attention to the news announcements that are coming out, but I don't dive into the actual, earnings reports and things like that for my swing trades. And then obviously with day trading, the futures markets, it's very technical base, looking at things like the NYSE tick and just the chart itself.
All right, awesome. Nice to meet you, Tim. Look forward to talking to you further. John Thomas, Mad Hedge Fund Trader.
That's me.
Good to see you again. Why don't you give the folks a little intro to yourself, if you can?
Yeah, I've been in the market 50 years, global, long, short, macro. You can find me at madhedgefundtrader.com. We have a daily research and trade mentoring service, which is up 36% or so far this year, and we're averaging 34% over the last 9 years. We cover stocks, bonds, commodities, precious metals, energy, and real estate, and we basically try to make money all the time, regardless of market conditions. And that is pretty much it. Find me at madhedgefundtrader.com. There you can sign up for a free research product that we have. We even send out trade alerts for free sometimes.
All right, thanks, John. Look forward to talking to you some more today. Neil Batho from TraderReview.net is also here. Neil, can you give us a little bit about yourself and your trading and your site?
Sure, Rob. Thanks for having me on the show again, David. Well, I was a broker back in 1999 at a big firm, and I learned very quickly that it's not really about managing money when you're a broker. It's really about managing clients. And they told us in the training, well, your job is to manage your clients' expectations, and your job is to basically transfer money from other accounts into your account. And you wouldn't get paid necessarily on performance, but some of the firms would pay you just basically on how much money you had under management. And there wasn't a lot of strategy involved except for cold calling, which I didn't really like to do. So luckily, before I left, I got invited to do, I keep wanting to say webinar, but it was actually a real seminar where people would actually come in and they got dinner, and it was on point and figure charting. And being right out of college and never teach you about technical analysis, I sure wish they would. And I was just completely amazed at this system with the X's and O's and how you can basically beat the market with less risk, and sector timing, market timing, all these things. And so a few years after that, I did some business consulting, and then later started my site, and I still use about 80% point and figure and 20% Ichimoku Cloud, and send out the trades to my clients.
Wow. Interesting. Thanks, Neil. And last but I don't think least, but we'll see. Norm Hallett. Hallett, is that how you pronounce it, Norman?
Yes, yes.
Okay.
Well, French is Hallett, but you can use it Hallett.
Yeah, I didn't know, you know, Stephen Colbert or Colbert, right?
Well, you know, the using the cloud and point and figure, that's like old school and new school. I mean, you must confuse yourself a lot. And John, hang on a second. John, don't be good to see you, John, here, because I don't want people to be afraid of the mad hedge fund trader, because he's not mad. This guy knows what he's doing. So listen to what he talks. My name is Norman Hallett. I am in the ass end of the business. I deal in the mental and emotional issues of traders, and it's the last thing that traders go to. Usually, the people that come to me are the people with one trade left in their account, just enough equity to buy one corn position or one share of Apple, because they just do not respect the importance of the mental and emotional issues. And I think everybody on this panel knows that it's at least a 50% deal with understanding how to control yourself. 38 years ago, I married a hypnotist, and that really changed everything for me trading-wise. She noticed that every time I would come out of my office feeling great, and she said, "You must have won today." And then, "I don't want anybody talking to me. You must have lost today." And she said, "You cannot let the market control you like that." I was getting nowhere fast. And, you know, through some mental training that she did with me, I was able to start controlling myself and follow my trading plan. That's what got me started. And now I think I'm probably the guy out there as far as mental and emotional issues is concerned with the disciplined trade. I've been doing it for 10 years, helped thousands of traders. So I think when you're ready to appreciate the mental and emotional part, I'm probably the guy that you want to come to, and I'd be glad to help. So I'm glad to be on the panel with guys that I know, and the respect that I have for all these guys, Rob and John, etc.
Hey, Norman, it's John Thomas. Great to see you again. I haven't seen you since that party in Vegas a couple of years ago. Maybe I should hire a hypnotist to hypnotize me into thinking I'm only 25 years old again.
You know, what happened to
Would that work?
Days in Vegas. What happened to that? Okay.
I think I hypnotized that out of my memory.
Okay.
All right. Thanks, Norman. Looking forward to hearing some of your insights. We've got a good mix today as far as what people look at and what they do with the the point and figure stuff and Tim's technical stuff. And I'm Rob Hanna. A lot of what I do is quant-based research. So I've traded for about 20 years. I started Quantifiable Edges in 2008. In 2014, I merged another site of mine called Overnight Edges with Scott Andrews, Master the Gap, and we became InvestaQuant. So the two focuses for me are basically swing trading, and then I do some overnight trading as well, meaning I'll get into the market near the close and then out again near the open for the futures. So looking forward to getting to know everybody. Let's start off by just kind of going through and saying whether we're bullish or bearish for the week, or as David says, which direction do you think the S&P 500 will move from this coming Monday's open to Friday's close? So we're talking about today's open to Friday's close. Are you bullish or bearish? And I'm really just looking for a one-word answer here so we can see where the panel's at, and then I'll come back and let everybody go into details on why you're thinking what you're thinking. I'll start. I'll say bullish. Norman, where are you?
I'll say bullish.
Okay. Neil?
Hey, Neil, you're muted.
Okay, I'm back. Bullish. I just said on there.
Okay. John, how about you?
Buy them.
You're what? I'm sorry. What'd you say?
I said buy them. We loaded the boat last week.
Okay. All right. Tim, that means you're bearish. Sorry.
Yeah, gotta be bearish then.
Seriously though, are you feeling bullish or bearish?
I am feeling bullish too.
All right. So
run.
Yeah, we're pretty overloaded on the bull side. So and then the interesting thing is we got a lot of different points of view here, I'm sure, because of the fact that we use a lot of different methods. So despite the fact that we're all kind of looking at the same direction right now, I think we'll still have some interesting discussion based on the fact that we're coming at it from different angles. So let me start with Tim. I'll go top down again now. Tim, what's making you believe we might be moving up over the next few days, and how confident are you in it? Is it are you strongly bullish? Are you feeling kind of about it, and you got to pick one? Where are you, and what's making you feel that way?
So if you asked me yesterday evening, I would say I was a little bit stronger bullish, and reason being just the chart itself and the way that we've been trending and holding the same sort of patterns throughout the last couple of months. There hasn't really been a breakdown of a major swing low or something taken out. And so I would say to add a second word to my bullish sentiment would be cautiously bullish. We've had a lot of topping tails up here, but if we can break above the on the S&P that 2946 and a quarter, that all-time high, I think we'll end up catching a lot of people off guard who are maybe trying to be strategically bearish up here. And if things don't go that way to the downside, then I think we'll end up with a lot of people trying to chase things a little bit higher.
Okay, yeah, interesting. Looking at a chart, I'm looking at the S&P right now. You're certainly right. I mean, every swing low, looking back to basically April, has held, right? I mean, each dip has gotten bought and led to another higher high. So it's tough to argue with the trend, I guess.
Yeah, and a lot of times, I may have a bias or a thought or feeling weak about the current trend, but until the chart confirms that, I try to just trade what I see and not get too engrossed in what I think might happen.
Yep. Okay. Thank you, John. What about you? You're also feeling a little bit bullish. Is it? Are you looking at other reasons? Are you looking at some of the same stuff that Tim's thinking about?
Completely different. The market is pretty much unfolding as we called it in January this year. That we'd hit an interim peak in January, enter a range from February until September, hit a new high in September, and then markets would keep grinding up in a slow motion melt up until the end of the year. And the reason is very simple: liquidity. All the money created by 10 years of quantitative easing is still out there and in the system. It's some $50 trillion of assets. It's all looking for a home, and the number one choice is still U.S. stocks. Strongest economy in the world, best earnings picture in the world. And we really have been in a slow motion melt up since June. And all we've really done is rotate back and forth between technology. And then when it gets too far ahead, we go back into airlines, industrials, and so on. So this trade deal with Canada could have been predicted many months ago, it's the go signal for a year-end rally. And the fact that the midterms are about to disappear in another month is another reason to buy the market.
Yeah, the midterms will be an interesting point of discussion over the next month, I'm sure.
Yeah, but that's all we'll do is discuss. In the meantime, we'll buy stocks. And it really makes no difference who wins. The mere fact that it is out of the way is a major positive for the stock market, for all risk assets, really.
Yeah, and we could. So you're saying we could get a relief rally, kind of, get the anxiety leading up to the election, kind of like we had with the Trump and Hillary election, and then.
Yeah, that always happens. It's not a relief rally; it's a relief all-time high. So,
okay.
And the cash is there for this to happen. I mean, everyone is still underinvested and has money coming out of their ears and was waiting for the 5% pullback, which never happened. And now they have to chase to the end of the year or risk losing their jobs at the end of the year for poor relative performance.
Yeah, and you imagine U.S. stocks too. It's as being
all U.S.
It's all U.S. There's been some pretty substantial declines overseas.
Oh, huge! I mean, China's off 30%, and the Chinese companies are actually growing at twice the rate ours are. But as long as there's a trade war, you don't want to go near China or any emerging markets. This is the year where the index players, passive index players, all look like geniuses because they're beating everyone.
Right. All right. Interesting. Thanks, John. Neil, how about you? What is it that your charts are suggesting, or why are they suggesting this week might be bullish?
I'm just bringing up the chart now. You can see the chart now?
Yes, I see it.
Yeah, so this is the main indicator that I use called bullish percent index. And you can see there's a scale from 0 to 100. It doesn't show the 0 because it never reached there in the last many years. But in the collapse of 2008, 2009, this reached 2%. And what this does is it shows what percent of stocks in the S&P 500 are on near-term buy signals. So your typical breakout, double, triple, doesn't really matter as long as there's a near-term breakout. And this is the indicator that you can basically never bet against. So it's not necessarily a weekly indicator, but you can see the number 8 here. That stands for August. So it's been in X's moving up since August. So the last 2 months, this indicator actually turned in X's somewhat time in July here, from 58% to 68%. And then if you look at the last 2 months in the S&P 500, so that
Neil,
was right about here. You can
Neil,
see.
I'm sorry, I didn't mean to cut. Just at your previous chart, the numbers along the bottom of the screen, were those years?
Yeah, I'll explain it. Okay. So these are the years here since 2012. I can actually go back and I can make the box size smaller, and then we can see where the crash was. And, 2009. Okay, it says I'm going to make the box size even bigger. Maybe. Good to see. So it says 5, but it's really 2.
Okay.
And so these are the years on the bottom, and then 0 to 100 at the top. And the way this indicator works is once it's really high, above 70, and especially up to 90 here, you can see the peak is 90. So you're never, basically statistically almost impossible for more than 90% of stocks in the S&P 500 to be on buy signals, because then at the end it's just the weakest of the weak going on buy signals. So basically, if anyone ever wanted a switch from the market that was an on-off switch, this is definitely your on-off switch, even though everyone says it doesn't exist. The crashes 2008, 2009, multiple crashes, and we've been in 100% cash anytime the Dow's gone down more than 500 points ever since I started my service, just using this indicator. And you can also use it on a sector basis as well. So I use this on a sector basis. If I go over here, remember, a quick example is the miners. Just a second. Gold miners. So here's a gold miner bullish percent index. And you can see back here, 2014, 15, 16, 0% of all stocks in the entire gold miners were on buy signals. And then once this starts ticking up, you can get massive moves. So we use this for trading Nugget. And then over here, when it reversed, we used JNUG, which is the triple inverse gold miners. And then we got 40% on that just a month ago. So incredibly super powerful indicators in point and figure. And I teach that in the member section.
Excellent. Thank you. All right. And now we're down to Norm again.
Yeah,
Norman.
that guy again. I gotta follow the point and figure guy. I mean,
Yep.
I love the point and figure. I forgot, you know, we used to use them when we got the charts every Saturday. They were gigantic charts. Do you remember that, John?
Sure.
You had to draw your own with a ruler, and we're constantly drawing.
Yeah, that's how they invented them, because they're easy to update it. You didn't even have to change it on some days.
Yeah. That's I remember. Oh, I got stories about point and figure, but it's a good way to look at things. I do want to. I just want to keep my comments general, because I'm going to kind of serve those that are listening by audio. In general, I would have said, if you gave me 2 words, I would have said cautiously bullish. But I've been cautiously bullish a long time, and I feel sometimes I should be dropping that. I mean, you look at the chart, you can't be anything but bullish. I mean, it's riding even the 9-day moving average. It's hugging. I mean, that's a very strong market. Not only that, the RSI has been oscillating between the mid-range of 30 and 70 and not exceeding 70 for all this year, since February. I mean, that's a strong market. It just shows you that there's just a lot of demand that keeps on coming, and probably some that's pent up. However, I think it was Rob that may have talked about the tails in recent all last week. I've been watching the market close near the lows of its trading session all last week. When you see all of those, you know, that sometimes alleviates the pressure and allows the market to go higher, as you're seeing it today. Sometimes it's an indication, especially if it's kind of a Three Sisters stair step type of a move down that precedes a big move down. But you know, I just don't see the big move down. There hasn't been a whole lot of volume. In fact, I just spent almost 3 weeks in China, and the market is about where I left it, within 1/3 of 1% of where I left it in the S&P. So, you know, it's begrudgingly higher. I think the only thing that scares me is that we're all bullish, and that when that happens, not only us, but I think in your survey that you report on your site, that concerns me a bit. But again, not enough to make me bearish. So I think if you're long, you got to stay long. The great thing about it is you can have some nice short stops and only be taking out 3 or 4 days of lows here. So it's a very, very good time to be long. But you know, even if you lose, it won't be a lot.
Yeah, and you bring up an interesting point about the market closing near its lows, and sometimes that relieves things. I've done a lot of research over the years showing that is in fact the case. A lot of times you might get a little bit of panic or profit taking into the close, and from an overnight basis, you tend to get gaps up the next morning a lot more often than not when you have weak closes. Also, I can't tell you the number of studies I've done where, you know, you look at say the market makes a 20-day high or a 10-day high and then closes near its low of the day. A lot of people look at that as, oh, it's a key reversal and we're due to sell off. But I found the opposite to be true. A lot of the time that selling at the end of the day ends up leading to higher prices over the next few days.
I mean, we can talk Tesla today when you want to talk about that. But in general, I think the traders out there have to watch that they don't misinterpret a market from a candlestick standpoint, a market that starts at a price, moves higher, and then closes near the low of the day and they somehow call that a shooting star. Shooting star has to be that makes sense to be cautious and look for lower prices. It's got to take out those lows, and you really should take, I mean, the highs, and it really should take out those highs considerably, and then close back within below the high that it broke out. Then you've got shooting star type of thing. But these kinds of days, I think somebody called them tails. That's that's more of an alleviation pattern, I think.
Yeah, I agree. All right, and then I'll throw in my 2 cents. I'm coming into the week. We had some bullish numbers based on the swing edges guides at InvestiQuant. Our swing guides were showing that there was a decent chance, looking out 5 days, that we would have higher prices. In fact, let me pull it up. Looking at, on average, about a 58% chance of a close higher on Friday, with a profit factor of about 1.3, meaning you'd generally, under similar conditions, if you were going long, you'd make 30% more than you lost on those trades. In addition to that, I'm not seeing any short-term bearish studies with my work at Quantifiable Edges. I got a few short-term bullish ones on, but for me, the market right now is it's a bit of a battle for my intermediate term bias. I am seeing some negative things. We've got kind of split market conditions where we've seen a lot of new highs and a lot of new lows in the market, and that can be a troublesome thing when you're at new highs, that you have this kind of split market. We're in a seasonally poor period right now, but we'll be coming out of that in about a month. So that's not an issue. And when I say seasonally poor, I'm looking at best worst 6 months, and I'm also looking at the presidential cycles. Normally the market does a lot better in year 3 and 4 of a presidency than it does in year 1 and 2. So it's unusual just how strong the market's been over the first couple of years of this presidency. And we've also got quantitative tightening that we've been dealing with, and that's a little bit of a negative force here as well. On the other hand, momentum's been trumping all, right? So we've had good, strong momentum, and it's just been carrying things further and further up. And I just don't feel you can ever get bearish when you've got this kind of momentum. So that's where I'm at with things. Let me go back and ask you guys, is there anything that you're looking at this upcoming week or in the short term that could get you to change off that bullish stance? Anything you're looking out for, anything that you see as potential trouble over the next few days or weeks? Norman, how about you? Is there anything that you're especially concerned about?
Well, there are, again, it's, no, I don't think there's anything I'm especially concerned about except for the sentiment figures rising. I do think that there has been some strength onto the market from the crude, the run in crude. And when we get to my trade recommendations, that's one that I want to be watching, looking for an overbought condition in the crude oil. I mean, we're way extended there, and today we're almost up almost 2.5% in the near month in crude, and that's after a nice run. And we've broken out to highs. We're almost at $80 a barrel. These are numbers that probably can't be supported in the short term here. From a technical standpoint. So there's a couple of things that I'll talk about maybe later if we get to that. But I would say that a breakdown in the crude, may be the start of some sort of a corrective action back to a trend line or back to that 9-day moving average. But I don't see a crash here, even if Kavanaugh is they pass on his nomination. I just don't think that's enough to do anything but see a little bit of profit taking of a minor degree. So I really don't see much this week happening.
Okay. Neil, what about you? Any big concerns that you're on, that are on your radar right now?
Yeah, I brought a chart up for that. Is the chart up again?
I see it.
Okay, so this is a TLT. The 30-year bond was 20+ year bonds. And I kind of been writing about this for several years, that eventually the bond bull market that started since 1982 is eventually going to crack. And you can see right here, it's at 116.5, and that's a bottom here, 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 going all the way back to 2017, and even here in 2015, this level here. And if I go to a monthly chart, if you only held bonds, in 2014, it was the best performing asset class, 35% for the year, while you just hung out in government bonds. But you can look here, we don't have too much to go on, but this is a big bull market in bonds. But I mean, ever since 1982, interest rates have been going down since they were at, I think, what was it, 15% or even 18%, down to 0%, and bonds are inversely proportional. Now there's nowhere to go but up. And so I look at a monthly chart here, and you can see there's just really no hope for bonds. And I don't know exactly how much is in bonds, but it's basically, I think, trillions. So this is going to be really dangerous. And I think this is going to be one of the trades of a lifetime, to be honest, to go short bonds. And you can do that with TMV. And that's something we've been doing some small trades on, but I'm just worried about the bounces. We did some puts on it before, but once this cracks, it's going to crack for the next 10 years.
Yeah, to answer your question, the global bond market is $100 trillion.
Okay, there we go. Yeah, I don't know how much are in these U.S. bonds, but I mean, rates are going to go up in Europe. They're going to go up, pretty much everywhere. So thanks for that.
Yeah, U.S. Treasuries are now at 21 trillion, and just U.S. Treasuries, and they're rising at 1 to 2 trillion a year now.
Yeah. Do you know the long bond? Do you have access to that, or?
That's a very small amount of the total. There's been a huge shift from long-term borrowing to short-term borrowing since Trump came in, and that's absolutely the worst thing you can do right now.
Yeah.
They should be locking in these generational low rates. Instead, they're borrowing overnight to reduce the assumed debt burden going forward. But the opposite is what happens. We've actually been shorting the bond market twice a month for the entire year and made money on all but one trade.
Nice, yeah. This is going to be a big one, and it's bound to crack. So TMV is the way to do it. Triple inverse.
Yeah.
So
our target, by the way, for this one, the TLT, is 105 in a year.
Yeah, I could see that for sure. Yeah. Because once it cracks, it's going to crack. It's just going to go.
Sell short bonds, and that'll be the cause of the next recession too.
Yeah.
All right. Well, I was just wondering if you had something for the next few days, but you're being a real downer. You're killing this. I mean, everybody's bullish. And you're just...
Let me tell you about my 100-year forecast, Rob. That's what okay. Yeah. South America. Anyway.
All right. Yeah. No, that's interesting stuff and well worth keeping in mind too. So,
but bonds are boring, so let's just forget it. Forget about it all anyway.
All right, John. Anything else that you want to add that's a concern for you in the near term or future?
Well, short for this week, we have the non-farm payroll on Friday. Nobody really cares about that anymore. The long-term number. We are at a full employment economy, so that's essentially meaningless in any case. Our big view is that we keep going up till the beginning of 2019, and then we start putting in the top for the whole 10-year bull market. So, corporate earnings drop from 26% a year growth to 5%. The effects of the tax package wear off next year, and that could be good for, good 10 to 15% drawdown sometime next year. But until then, buy them like crazy. This could be your last chance to make easy money for a while.
All right. Thank you, John.
And by the way, our 2030 forecast is Dow 120,000. And if you want to find out why, just read my newsletter.
Okay. You're forecasting way ahead of where I would. I forecasted out about a week or two at the furthest.
I got a funny comment on that. I just got to butt in here. Is that back in the 80s, the Soviet Union would always say they were were such geniuses because they'd have these super long-term plans that never really ended up working out so well. And then they'd always say the U.S. is all short-term oriented. But the hilarious thing now is you got the CEO of Apple and some other CEOs saying, we just don't like this quarterly reporting anymore. We want to report every 6 months for more long-term planning. And to me, that's just something I put on the side as a kind of a bearish overconfidence type of signal, because can you imagine during the financial crash if they said, well, we got to wait 5 months because no one's going to be reporting any earnings for a while? People would freak out.
Yeah, ask the shareholders of General Electric what they think about semi-annual reporting.
Exactly. So I didn't like that at all. I think when you have that type of overconfidence and what's the word for it? Brazenness or something.
Hubris. It's called hubris.
That's the one. Yeah.
I'll throw that in with the basket of 100 other long-term topping indicators that we're seeing. You could write a book on how many topping indicators there are right now.
I'm glad we don't have Wiz here right now. He'd have a whole bunch of sayings for us. Well, I wish we did have him here right now. I just want to butt in on that. I found that to be pretty strange and not good for the market.
Yeah, that's an interesting point. Thank you. And then Tim, how about you? Is there anything on your radar that's concerning in the next short term or longer term?
Yeah, in terms of the next couple of days or week, if we come down and break the most recent swing low, the 2907 on the ES or on the S&P, that would, like we were kind of talking about at the beginning, be the first time that pattern has really broken in the last couple of months. But it would be great if we could get a close, not just a pierce into new highs, but actually a close above 2941 to kind of begin that next push higher. But my bias would definitely shift a little bit, at least in the very short term of a couple days to a week, if we start taking out some of these swing lows that are below us, just from the chart perspective.
Yeah, and looking at the chart, this is about as small of a swing as we've seen in the last few months. Also, I mean, the other ones had, like 1 day scares or 2 day scares, but they were all a little bit deeper than what we've seen over the last week or so. Maybe that's because, I'm looking at the S&P, but if you look at the NASDAQ, there is no swing low. That moved higher last week while the S&P pulled back a little bit, and we're just hitting new highs today. I guess that swung lower earlier, right? That was beginning of September where that hit its most recent bottom and has now moved out of there. But yeah, good technical levels.
Especially like on the NASDAQ, there's a lot of mix in some of the bigger names that your Apples, your Amazons, and Netflix and things like that. They're not breaking out all of them to new highs. So if some of those start turning upwards, then more momentum would be expected to continue.
Yeah, and we some of the FANG stocks, like you point out, had some real hits in the last month or so. So it's kind of amazing that we've held up as well as we have. All right, let's get to the question of the week, which I'm gonna go in more random order, I think. Let's go alphabetical. Neil B. What procedures do you use for trade management? For instance, position sizing, stop, scaling in and out, etc.
Well, I use something called the percent risk methodology, and if you sign up for my newsletter, you get the software I got someone to make for me way back for Windows XP. So the way it works is you type in how much of your portfolio there is. You type in the stock price, type in the stop loss, and then it'll calculate how many shares you should buy so that if you're stopped out, your portfolio only drops 1%. So if you got a really volatile small cap biotech stock, sometimes that stop could literally be 40% away. It's just crazy volatile. and
Right.
so you put less in. But if you're going to go for something like a triple leveraged index, normally we're about 40% in something like that because the stop is so close. We try to time it so well, and so that way you make money on slow moving things and you make money on fast moving things, and you don't lose your shirt by putting in too much. So if you just look up percent risk methodology, it'd probably be on there on a simple internet search.
Okay, great. Norman, how about you? What are your favorite methods for trade management?
Well, I don't propose. My business is really not recommending trade processes. I can take a look at a trading plan and help to shore it up. But I would say that some of the rules that I look at is some of the rules that I go by, for instance, would be things like be shy about pyramiding and only pyramid winning positions only when they continue to reflect favorable risk reward ratios. I only risk 2% on any particular trade, and most of the time try to find something that's less. I try to stick with 2 to 1. And
when you, I'm sorry, when you say 2%, are you talking about 2% of the portfolio value, like Neil was discussing?
Yes, of the portfolio value. Being a futures trader myself, I can turn to what I do. Sometimes I'll have 2 or 3 positions on at one time, or 4 positions on at one time, and I make sure that basket of trades never exceeds 5%. And so if I have 3 trades that are already taking up that 5%, I won't put on that 4%. See, I'm always defending against my mental and emotional structure. In other words, I do not want that 6-8% loss or more where I'm getting punched in the solar plexus. So I do everything to defend against that so that I'm there to trade another day. I look for 2 to 1 and preferably 3 to 1 reward risk type ratios. I always lock in at least a portion of a windfall profit. I like to trade multiple positions so that I can scale in and scale out. Mostly, I've learned to put on the majority of my positions in a total approach early and then scale out as the market moves in my favor. I really do like that because you never know what to expect, and it's always a feel-good thing to take profits along the way, but you don't want to take out the top, so you leave 1 or 2 positions or whatever percentage on. The more active I am, the less I'll risk on each trade, as I mentioned. I never add or average down to a losing position. And I'm always willing to stop trading and reevaluate the markets and my methodology when I encounter a string of losses. And that usually happens when I ignore things like seasonals, things on that order, when I usually miss something from my overall fundamental analysis that draws me to the technical ins and outs of a market. So I usually, because I trade a lot of commodities, for instance, I'm always zooming in on grains in the spring because I know that's when they tend to make their moves. But I just don't go buying in April. I wait for my a signal to get into the direction of the flow. So those are some of the things that I do from a risk management standpoint.
Excellent. A lot of good ideas. So thank you, Norman. Tim, what about you? What are some of the things you do for trade management?
So I'm also an all-in kind of a trader, and I like to scale out. So one of the ways that I like to exit positions, if I'm long, trailing my stop throughout the way, scaling out by either trailing each candle or trailing swings. So that could be a daily chart, an intraday chart. But rather than trying to pick exit points, scaling out along the way based on when that short-term momentum might be changing is the way that I like to scale out. And with swing trading, especially trading overnight positions in the stocks, trailing the swing low every time we pull back and then make a new high, as we've been seeing in the last couple of months, you can stay in these trades, continue to raise your stop and lock in profit along the way without really letting the market come back too far against you. And that's one of the reasons why the significance that I put on a break of one of these recent swing lows would be kind of a red flag for me, at least in the short term, because that would kick me out of some of the swing trading positions that I have. And is also to something that Neil and Norman touched upon. You know, this applies more with swing trading, but if I was day trading, you know, I try not to put on multiple trades that are in correlated markets. Like I typically don't put on a NASDAQ trade and an ES trade if they're trending very similarly throughout the day, because I'm basically just doubling my position size. And with swing trading, if I have a basket of stocks, I'm looking at how many positions do I already have on that have profit locked in that I've either scaled out a portion of, or I have raised my stop if it's gone in my favor. And so if I don't have any positions on and I put 5 positions on at once, I'm basically have, you know, 5 times the risk of one position. If I've got 4 positions on already and 3 of them have locked in profit, and I'm going to put another 1 or 2 positions on, you know, now my overall risk is essentially not as high because I've already locked in some profit or reduced my risk on some of those other positions. So, you know, looking at the stocks that might be lagging or just not doing much, and maybe closing out some of those and allocating those funds to something else is something that I look at a lot with, you know, managing the, not just the individual position, but the collective portfolio.
Okay.
Thanks, Norman.
Good stuff, Tim. Thank you. I know Norman liked it at least. John, how about you? What procedures do you use for trade management?
Well, we run very small, narrowly focused portfolios. Basically, we only want to be in the longs that are going up and the shorts that are going down. We never put more than 10% of our cash in a position. We try to balance out long positions with short positions, although that's been kind of tough this year because practically everything has been going up. So our short positions have tended to be in bond markets or longs in volatility index. And we have been quite successful at that. So, you know, long stocks, hedges with the volatility index, that's the way to go in this kind of market where things are just going up practically every day. And we also run very rigid stop loss disciplines. As soon as, you know, a position goes more than 1% against us, we stop out. It's much easier to dig out of a small hole than a big hole.
Yep. Okay.
By the way, that's often the biggest way that individual investors lose money is once things go against them, there's that eternal hope that things will get back to their cost and they can, you know, get out for even. And then the bigger mistake they make is then doubling up a bad position to reduce their costs and hoping they can get out of cost that way. And that usually doesn't work either. And that's how you end up losing all your money.
Norman, you're laughing. I take it you've dealt with some people that have done that.
Yeah, you know, average down. There was a guy that wrote a book years ago called "You Can't Lose Trading Commodities." I don't know if anybody's ever read that guy. I'm sure he's in jail. But the guy it had something called scale trading, where you watch for a market that was at a 20-year low, like, I don't know, cocoa, and you bought, or let's take gold. Say you bought gold at $300. And then you bought another contract at $290, another one at $280, and another one at $270. You held all those losses. When the market rallied, you'd sell the $270 at $280, the $280 at $290, but whoops, it's coming back down. You reestablish the $280, back up $290. When you get to $310, you've taken all your profit. But some of that loss on the way down is, you know, you feel that, especially when you realize that 20-year lows can easily become 30-year lows. Ask any farmer. So I laugh because I remember that book, You Can't Lose Trading Commodities, and and yet no matter how stupid that sounds, people are averaging in their positions all that, and somehow it makes them smart. They don't want to be wrong, so what they do is they take another position to reaffirm their idiocy.
Well, having been in this business 50 years, I can tell you it's amazing how creative people can become when it comes to finding new ways to lose money. Probably 50 or 90% of all of the financial newsletters out there now are recommending naked short put positions. And, you know, those people be driving Uber cabs in a year. So any you know, subscribers who follow those strategies will be driving Uber cabs right along with them.
Wow.
Yeah, I find when you're in a bull market, everyone's a technician. And when you're in a bear market and you're holding something and it keeps going down, you all of a sudden don't become a technician anymore. You become this genius fundamental analyst who.
That's right.
For sure, this company is definitely going to pass that FDA test and will cure all the diseases in the world. And you know, because you've read all the reports and you've held it from 9 to 8 to 7 to 6. Now at 2, you're loading up, man. and it's unreal. So, I mean, you know, I always say fundamentals are never going to bail you out, no matter how good they look. If the stock's going down, it's going down for a reason. It's a reason you don't know, but there's always a reason.
Well, I think John said it when, you know, I mean, 1% may be a little bit short for a lot of people, but that's erring in the right way. I mean, you can always, you know, all you have to do is make 1.05% back to get back the 1% loss. Once you start taking 10 and 20% losses, you got to, you know, make 30 and 40% profits just to get even. So there's some wisdom in that, you know.
Yeah, and so for my own trading also, I found that a lot of it depends on the style of trading. You know, if you're talking about a 1% loss or some type of tight stop, or even really any kind of trailing stop, that works very well when you are in some type of breakout or trend following type of using some method like breakouts or trend following, right? Because the reversal is the confirmation that whatever you're in is you're wrong about it. Okay, so it's something's changed and it's time to get out, and you want to really ride that as far as you can. Whereas the flip side of that is there's swing trading methodologies where you might be looking at mean reversion type stuff. So you'll buy over sold and then get out when it reverts to a mean. So buy a 5-day low, get out at a 5-day moving average. And in that case, I haven't found stops to be effective. But what you need to do is position size correctly, because you really, you know, you got to assume that you can lose just about everything on the position. So if you only want to risk 2%, you only take 2% of your portfolio in there, or 3% of your portfolio if you know, if it's a stock that's S&P 100 or something. But you got to assume there's a big loss in there somewhere, and you're gonna face it. So I think trade management really depends on the personality of the person, the method they're using, and it's not just one answer. And we've got a lot of good answers here today, and you just kind of got to find something that works for you and works for your methodology. Tight stops and pullbacks aren't going to help. Tight stops on breakouts should help, as long as you're timing your breakouts well. So let's wrap it up here. I guess it's about 2 o'clock. Let me go to
Rob. May want to handle that question I see there on the bank and finance.
Yeah, we had a live audience question. It was anyone have a comment on the banking finance sector now that we have that we're past the September Fed meeting?
We have a major piece coming out on this tomorrow on fintech. Banks are the new buggy whip industry. They are all running legacy business models that are 200 years old, and thousands of small fintech companies are eating their lunch. That is why you've had every reason in the world for the bank shares to go up this year, and they're all down. And that is, except for the brief short covering rally, that is going to continue.
Even the small banks, John?
Anybody who has a brick and mortar branch network is not going to be able to compete with an online bank where the costs of execution are essentially zero. It turns out also that algorithms are much smarter at making low default loans than humans are. Anyway, read my newsletter tomorrow. It's all in there. madhedgefundtrader.com.
All right, great. Anybody else want to pipe in on that question? If not, we'll get to the wrap up and let you guys see if you got any trade recommendations for the week. So Tim, if you want to let us know anything, I'll start with you. Anything you got going on there at eMiniMind that you'd like people to be aware of, and then also if you have a trade recommendation for the week.
Yeah, so a break above the high from last week here in the S&P, I think would be a strong rally to follow. Just talking in the terms of intraday or just a couple of days, and a break below, say 29.05s, might see some short-term sell-off. And the shorts are always the trades that move quickly and can really capitalize in a hurry. So even though I'm bullish, I'm kind of watching for signs of maybe a short-term, little bit deeper pullback, just because we are kind of trading in such a narrow range. So I would say, longer term through the end of the year, definitely bullish. I tend to see, coming off this Fed meeting in September, the trend that ensues is typically a lasting one. People tend to wait till that time to kind of come back and start putting their funds back into the market, for those that may have scaled out over the summer or just kind of took a little bit of time off. And so I would say longer term bullish on a weekly, monthly perspective, but on the short term, maybe looking for a few short opportunities here. And if we do break above 29.46 on the S&P, I would definitely be looking to jump on that and ride it up higher.
All right, great. Thanks for your contributions today, Tim. I hope everybody checks you out at eMiniMind. And
yeah, thanks, John.
Look forward to talking to you again in the future. John, how about you? You got a trade idea for the week or anything you want to listen about?
I'm looking for S&P 500 3,000 by the end of the year. That's up 3% from here. It'll continue to be a slow motion melt up, as we have seen. So buy every dip in commodity in tech, and also buy every dip in industrials and domestic. Just keep rotating between those two groups. Looking for bonds to hit 315 to 320 in the 10-year yield by the end of the year. And the sleeper trade for 2019 could be commodities, because inflation will finally start to kick in next year, and the commodity should take off like a rocket when that happens. So you would get our free research. Go to madhedgefundtrader.com, enter your email address, and get on the bandwagon.
All right, thanks, John. Neil, how about you? Anything you want that you're looking at for this week as a potential trade idea, or and anything you got going on at traderreview.net?
Yeah, sure. It's just a TLT, like I mentioned before. Keep your eye on this, and
okay.
I think if it breaks down to about 115.80, I think that'll pretty much be the point where it's just not going to come back, and you can trade that with TMV, and that could fairly volatile, but literally something you could hold for several years until the Fed's going to pause in rates or give any type of indication that they're going to pause in raising interest rates.
Yeah, and by the way, we don't think the bond market hurts the stock market until the 10-year yield goes over 4%, and that's about a year off. Still too much liquidity.
It's funny you say that. I did some research into that years ago, and that's right about the percent where things seem to start mattering. Based on what I was looking at. So, but
well,
right.
Also next year, we may be looking at a stock market that only goes up 4% and a bond yield of 4%. So you hit a tipping point where all of a sudden the risk reward overwhelmingly goes in favor of bonds compared to stocks for individuals.
Right.
That'll be sometime next year.
Okay, Norman, anything you want to let us know about the disciplined trader, or and if you have a trade idea for the week, that'd be.
I have a trade. I'm still working on melting up.
Yeah.
I don't know if you have a trademark on that, but I try to get one because that's quite a concept, up melting. But I would say that, again, I would bring you back to, I've been doing a lot of work recently with the oversold and overbought area. I've been, and I think that, I'm looking here at the crude oil just continues to go higher as we speak. And, we're already at a 73 reading on the RSI, and I use the 14 length on the RSI, 70 overbought, 30 oversold for those that are looking to set their computers to that. But I usually like to see, when I see an 80 overbought and then I see a candlestick reversal, that combination is usually good for a couple of days of trading. It's a very short-term thing, but I think that we look like we're getting overheated here in the and I don't know if Tim would agree with it. He trades some futures. But I think that I would be looking for a counter move in the short term and shorting the crude at the right time, because we're getting all the indications. I'd like to see the confirmation on a candlestick. Maybe the beautiful thing would be a doji, but I would accept an inside day or some sort of other encompassing reversal. But I think that'd be good for a couple of bars. That's what I'd be looking for in the short term.
All right, great. Thank you, Norman. I hope people check out the Disciplined Trader as well. It was great getting to meet you and talk to you. Interesting stuff. And then for me, you can learn more about what I do in my research at either InvestiQuant, where I have a lot of overnight stuff that you can check out. Also, we have our Swing Edges product there that looks at odds for the next 1, 3, and 5 days for large cap stocks and indices. Additionally, you can check out Quantifiable Edges, and I write newsletters at both sites too. So you can take free trials of my work at Quantifiable Edges or InvestiQuant and InvestiQuant. As far as a trade idea, a couple of big caps I was looking at coming into today were American Express and PayPal for short-term bounces. Amex kind of gapped up, so that's I wouldn't chase it here. But PayPal hasn't done much today, so that may be one that could get a little bit of a bounce over the next few days. I don't look at these swing trades for long term. If it closes up 2 or 3 days, or if it closes up above short-term moving averages, that's generally where I'm looking to exit my swing trades. So that's it for me. Thank you to David for inviting me back, and it was great getting to talk to all you guys today, and I'll look forward to seeing you again in the future.
Good job, Rob, on the management. Yeah.
Thank you.
All right. Thanks, everyone.
Thanks,
just a reminder, be sure to subscribe to Timing Research on YouTube and your favorite podcast directory. And you can also go to TimingResearch.com to get access to any of the past reports or past show archives. Also, be sure to join us tomorrow, October 2nd, it's Tuesday, 4:30 p.m. Eastern Time, for the next episode of Analyze Your Trade. Hema Reddy will be on that show for the first time. She's been on the Monday show before, but she'll be on Analyze Your Trade for the first time. Also, Dean Jenkins, Christian Fromhertz, and Jim Kenny tomorrow. So finally, just want to thank my guests again for this week. Tim Racette of eminimind.com. Thanks for being here for the first time. As well as Norm Hallett of thedisciplinedtrader.com. John Thomas of madhedgefundtrader.com, Neil Batho of traderreview.net, and Rob Hanna of investaquant.com and quantifiableedges.com. Thanks, everyone.